and I want to welcome you to our webinar today on a comprehensive review of client settings in RightCapital. Now, the goal of this webinar is to walk through the foundational assumptions and settings that you can establish within each client plan. Now, during this webinar, we are going to be, of course, diving into what each of those settings entail and how they have impacts into the client plan, and also, very importantly, how to set those as presets. So that way, going forward, any client that you create going forward will also be leveraging any of those presets that you have established. Now, towards the end of this webinar, we're also going to be walking through the different resources that you do have available to you when leveraging RightCapital. One of those resources being that during this webinar, if you have any questions, please feel free to use the Q&A drop down to type out your questions there. More than happy to answer any questions you might have. Now, switching gears into RightCapital. So we're going to be starting the conversation off in a client plan. This is going to be the case study that we're looking at today. So starting in the profile blueprint module, this is where we will see a nice kind of easy to understand visualization of the client's current plan. So before we dive into the impacts of some of those settings and how it impacts the future projections and a couple other pieces, it's important that we understand who we are looking at today. So starting with the Lannister family, under profile, blueprint, and under net worth, we can see that the Lannisters have a current net worth of $2.2 million. That does include some debts, their primary home, and they're also in their late 50s as well. And they also have a child that's exited college just a couple years ago as well. And under their goals, we can see their goals across their lifetime, starting with the family vacation that they're taking this year. They also plan on retiring at age 67, respectively, in a couple years. Now, for current income, savings, and expenses, this is where we can see what's happening in terms of that current income stream. They have some pretty decent income coming in, some pretty decent saving habits, and also some decent spending habits to note as well. But now that we kind of have a better understanding of who we are looking at today, we're going to be navigating to one of the very most pivotal places of RightCapital that we can go to in terms of determining the assumptions and the settings for each client plan. So going into the gear icon settings section, this is where we access the methodology page. So we're going to be really establishing and walking through what each of these different settings entail, starting with one of the very first and very important assumptions that you can determine, which is the planning methodology. Now, one thing I want to note is that every single client plan, you can indicate unique assumptions per client. So everything that we're adjusting here, and a good rule of thumb is that when we're in a client plan and we're accessing the gear icon settings section here, we're adjusting this particular client's settings. So we can adjust these on a client by client basis because, as we know, every single client plan can be different. Their needs might be different. So whatever we might be indicating for the Lannisters might not be translating for other clients that we might have, starting with the planning methodology. So for the planning methodology, from this dropdown, there are 3 different types of planning methodologies available. Now, this is a very important first basis assumption that we're establishing here. So the main 2 options that we have that kind of overlap are the cash flow based planning assumptions. Now, the cash flow based planning methodology, when we select that, what that means is that it's going to be considering everything we enter in the plan when it comes to income, expenses, goals, and saving contributions, but it's going to be assuming that at the end of the year, any surplus cash flows are automatically going to be saved into the taxable bucket. So this is going to be one of those comprehensive financial planning approaches. But the main thing here to note for the cash flow-based planning methodology is that it assumes that at the end of the year, every single extra dollar that we have that's not devoted towards paying a designated expense will be automatically invested into the taxable bucket. The second option for planning methodology is what's referred to as the modified cash flow based. Now, this one has a similar approach. It's still that comprehensive financial planning methodology. It's going to be considering everything we're entering in the plan when it comes to income, expenses, goals, and savings. But what's going to be different here with the modified cash flow based planning methodology versus cash flow based is that with modified cash flow based, it's going to be running with the assumption that at the end of the year, any surplus cash flow are going to be automatically spent off. Now, what that means is that if we're just assuming that it's automatically spent off, you also can further control saving contributions. So you still have the opportunity to designate that we want to look at maybe the potential of saving into the taxable bucket, or if that's something that we know that the client's doing, we know that, at the end of the year, the client prioritizes saving $10,000 into the taxable bucket, we can designate that with this approach. Whereas if we selected cash flow-based planning methodology, it's going to assume that every single dollar at the end of the year is automatically reinvested. Now, just to show what this looks like, we have modified cash flow-based selected, which we currently do. One of the places we can see the outputs of that designation of that planning methodology is going to be found under the retirement module. Now, under the retirement module, we go to cash flows. And under the summary tab, this is where we can see the year-by-year breakdown of the client's cash flows. Now, this is going to be one of the secondary gauges of financial well-being. This is where we can see a lot of insights when it comes to the client's financial plan and also the well-being of the plan as well. So there's a lot of great insights we can find here. One of the things that we can do is we can click into these column headers to see a breakdown of what is making up each of these line items, these expenses or income streams. But one of the very important things to note that you'll see a difference of if you're swapping between modified cash flow-based planning and cash flow-based planning is going to be the spend on saved cash flow columns and the net flows columns. So right now, for example, we have modified cash flow-based selected. So what that means, just as that kind of reminder, is that we're having that comprehensive financial planning approach. We're considering all line items that we're entering here. But at the end of the year, unless we have designated otherwise with the savings cards, we're going to be assuming that any surplus cash flows are automatically spent off. So that's why we're going to see here the spend on saved cash flows column. But what that does is it allows for us to look into this space. We can see that, hey, we have some kind of saving opportunities happening here with this client. We see for the next couple of years, there's a plethora of surplus cash flows. Maybe we're looking at proposing that they save into the taxable brokerage account. What that means is that we can go to retirement analysis. And this is where we access that first gauge of financial well-being. That's that probability of success. That's going to be looking at the Monte Carlo simulations and 1,000 trials of market volatility. And it's a percentage of those trials that make it to the end of plan without running out of money. So this is where we can see that first gauge, but it's also where we can start to go to create a proposed plan. That's where the action items comes into play. Now, the action items are what we use to indicate and propose a change to the selected proposed strategy. So right now we have one of my already existing proposed plans selected, the retiring and downsizing situation. But since we have modified cash flow based selected, and as we were looking at the cash flows, we saw that there was an opportunity to start and continue to save more on maybe this particular plan. If we wanted to propose savings, we can click on the edit button, click on add new items, go to savings, and we'll see the option for taxable brokerage savings. So when I click on this card, I can then start to carve out what I wanted to propose. And maybe this is what we're trying to do, is we're trying to illustrate if we start to save more, we can start to bolster our assets just a little bit further. So we can designate that $10,000 we wanted to save into the taxable brokerage account. We can indicate the owner. We can have it start for this year, and we can also have it tied to Tyrion's retirement, which is exactly what we want to do, and we can hit save. Once that loads, we're now going to see how that's going to impact that probability of success. We're now baking into this proposed plan the idea of them saving into the taxable brokerage account, because when we were looking at that cash flows, we were seeing there's opportunity to do so. And because we have modified cash flow base selected, we have the ability to further control the savings that we're making in terms of the proposed plan. And the same thing too, if the current plan they're saving into the taxable brokerage account, we can also designate that as well. But if we switch to the cash flow based planning methodology, we go to gear icon settings once again. And if we swap our planning methodology to cash flow based planning, which is going to assume that surplus cash flows at the end of the year are automatically saved into the taxable bucket. And if we go back to the retirement cash flows, it's going to be a little bit of a different look and feel. So under cash flows and going back under summary, Now we're no longer going to see that spend unsaved cash flow column, because now we're assuming that every excess dollar at the end of the year, when we're looking at this year by year breakdown of cash flows, are automatically invested into the taxable bucket. So that's why we're going to see a positive net flow. So whenever we see a positive net flow like this, just to note here, that's going to be indicating that we're saving into the taxable bucket. So it means we're reinvesting proceeds from a sale, but especially when it's cash flow based planning, that's going to be the assumption that we're saving every excess dollar. And if we wanted to see that addition to the account or the savings, we can go to the accounts tab. And this is where we can see that ending balance by accounts across all those years. But if we use this drop down, we can toggle to additions to accounts, and we can see that surplus cash flow being reinvested into the taxable bucket, or being invested into the taxable bucket. Just for reference, if we're looking to see what that looks like, that is what it's going to entail. But especially because we have cash flow base selected, it's assuming that everything is being saved. So that means we can't propose saving into the taxable bucket since we're already saving all surplus dollars. So that's going to be a very important designation, and it's a very important assumption that you're building out per client. Now, for some clients, the cash flow base might be better suited for them. Maybe it is something they're already doing. Maybe they're post RMD age, they're automatically saving everything. Then we can select that option. And the other kind of situation, if that's not the situation, and maybe you're looking to propose and illustrate the impacts of saving into the taxable bucket, that's when the modified cash flow based assumption can come into play. Now, there is a third and final option when it comes to planning methodology. We go back to gear icon settings. The third approach here is going to be the goals based approach. And this is a little bit of a different approach when it comes to planning methodologies. What this is going to be doing is it's going to be a little bit more of an isolated purview when it comes to the projections. Goals based is going to be focusing on the savings and goals that we've entered in this plan. So it's going to be ignoring the income and expenses and other kind of line items we might be entering. So just to show what it looks like if we have that toggled, hit save. If we go back to the retirement cash flows to see that gauge of their financial well-being, under retirement cash flows, now we're going to see a lot less information, and that's going to be because we're just focusing on the goals and savings that we're entering with goals-based planning methodology. Now, especially if we're maybe looking at a client, maybe it's a prospect, we don't have all the information yet, or maybe it's a client, we're just focusing on the retirement picture, we're just trying to look at the assets growing over time, what it would look like if we saved into them. Here with this particular approach, it's going to be a lot more of an isolated purview. So we'll see just the net worth, the growth of net worth over time, and the accounts and the growth and any sort of adjustments as well. So it's going to be a little bit more of an isolated purview. It's still going to be considering other things like Social Security income, because it really is more kind of focused on that retirement picture, to put it in better words as well. So a very different approach when it comes to the cash flow based planning methodologies. But if we go back to gear icon settings, I'm going to be switching back to modified cash flow based planning, because there are going to be a couple other sort of settings that it's important to note when it comes to modified cash flow based planning specifically. So for modified cash flow based settings, especially with this particular methodology, and because we're assuming that at the end of the year, all surplus cash flows are automatically spent off unless captured with a savings card, a very important life event that happens for a lot of clients is RMD age, or required minimum distribution age. And another very popular methodology when it comes to hitting that age is typically one of those approaches is automatically saving any sort of non-spent off funds from the RMDs or distributions into the taxable bucket. So if we're taking that approach, we do have another option here when it comes to modified cash flow based planning methodology, which is to indicate whether or not we want to assume that we're spending unsaved RMDs or distributions from accounts. So this is going to be another important designation here. If I keep this deselected, what it's going to do is it's going to assume that when the client hits RMD age, or if we have any distributions coming from their accounts, that any proceeds are going to be automatically kind of reinvested at the end of the year. So if something's not being captured with the expense, it's going to be automatically reinvested. If I select the setting and I indicate that I want to have the assumption that we're spending any unsaved RMDs or distributions, that means that if we have any of those distributions occurring, that we're automatically spending those off. but that doesn't mean we can't capture them with a savings card. So with that approach, if I kept this selected, I could still indicate a taxable brokerage savings card and indicate I want to save maybe $25,000 at the end of the year when RMDs are kicking on, and have that kind of reinvestment, and then assume that the rest of those kind of distributions are spent off. So you do also have that very important assumption that kind of ties into specifically the modified cash flow based planning methodology. Up next, for one of our other very important assumptions, is the withdrawal sequence. So for withdrawal sequence, we've got a couple different options here, but this particular planning methodology, what this means is that this is going to be that idea that we might have already seen this, and I see a couple of you have already asked about what that meant. When we were looking at the cash flows, there were a couple of years that this client had a negative net flow. So what that means is that in the cash flows, when we're looking at that year-by-year breakdown, that in a year where the client does not have enough income inflows to cover their outflows, the system automatically knows that we are going to be pulling from our assets to fund those expenses. So that's what that negative net flow represents. It's representing us pulling from our assets to fund those outflows. Now, the withdrawal sequence that we're indicating here is going to be what we're using in terms of the prioritization of us pulling from assets to fund those outflows. So for example, right now I have taxable, then tax deferred, and then tax-free selected. So if we have depleted the taxable bucket with those outflows and those kind of pulls, we would then look towards the tax deferred asset and then tax-free if all else is depleted. Now there's a couple of different approaches we can take from here. The first one is the pro rata approach. What that means is that we would pull proportionally across all accounts to fund any sort of outflows if needed. Other options we have, like the default that I just stated that I have selected, is taxable, tax deferred, tax-free. Then we also have taxable, tax-free, and then tax deferred, or we can take the taxable, then pro rata approach, or a couple others as well. So what we indicate here is going to impact the current plan's assumptions. If you are leveraging the tax strategies tool in particular, and you're proposing that they take a different withdrawal sequence, and you activate that as part of the proposed plan, then you can indicate and propose different withdrawal sequences. But what we designate here under the settings is building out the foundations for the baseline plan. Another very important assumption that we're going to be reviewing is the allocation method. Now, the allocation method, for example, the default that I have selected is same allocation for all years. What this means is that it's assuming that our asset allocation that we have designated is going to be the same across all years of the client plan. We do have a couple different options here. One of the other ones is the pre and post-retirement allocation. What this would be entailing is that at post-retirement age, once they retire, it would be indicating that the client's going to be going into a designated asset allocation. So for example, if I select that option, I would then see the option to indicate a post-retirement allocation for the current plan. So if we know maybe this client, once they retire, we're going to be putting them and allocating their investments in their portfolio into a conservative model portfolio, we can select that from here and hit save. Another option that we have is also enabling the glide path. So the glide path is a little bit of a different approach. So the pre and post-retirement allocation is going to assume an immediate shift at retirement to that designated allocation. The glide path is typically used to model a slower shift over time to a more conservative allocation post-retirement years. But the glide path itself is completely customizable. You can create custom glide paths, and I'll show us in a second how to do so. But if we enable a glide path, you then have the opportunity to then indicate which glide path you want to select for the current plan. Because what we indicate here will also determine if we can make proposed suggestions and the proposed strategies for any of these allocation methods. So same thing for glide path as well. So from this dropdown, we can indicate for current plan, no glide path. We can select the default glide path that's available with RightCapital or any custom ones you might have created. When we select that glide path, we would then be seeing that that's going to be part of the allocation. But what's going to be really important here is the grading schedule. Now, the grading that we indicate here, right now I have 40 years selected. If I selected 1-year grading, that would just be indicating to the system that would be shifting to the glide path as next year, essentially. If I selected 10 years, what that means is that slowly, proportionally over the 10 years, the next 10 years, we would be slowly shifting to the glide path and allocating the client's asset allocation to mimic the glide path that we have indicated. So the grading schedule is going to determine how quickly we are putting the client's portfolio into the glide path and mimicking the glide path that we have indicated. Now, to see what the default glide path is and to create own custom glide paths, we would do that by going into the advisor portal. In the advisor portal, if we go to models and under the glide path, this is where we can see that default glide path, but it's also where we can go to create custom glide paths. To do so, we can click on this add glide path button, or we can copy the default glide path and build from there. Same thing if for any of my custom ones, I want to continue to build off of it, I can then click on the 3 dots and hit copy or rename it or delete it if needed. So this is where we can go to see what the glide path looks like. We can see the years to retirement, the equity, income, or cash split. And then when we hit retirement, that's going to be considered year 0. So just for reference of where we can find what the default glide path is or create custom ones if desired. And then, like I said, if you create that custom one, you can always indicate that as part of the glide path that you want to select when using that drop down. But switching gears back into the family plan. And if we're wanting to see an illustration of what the glide path or the allocation method that we have selected does to the client plan, if we go to the investment module, under allocation path, this is where we can see that visual representation of the client's allocation path across their lifetime. So for example, I have pre and post-retirement allocation still selected. So we're going to see here that during their working years, the pre-retirement years, they're going to be in their current allocation in that split. But once they retire, we're going to see that immediate shift to the conservative model portfolio that I have indicated. And we can kind of see here what it would look like if they shift to different portfolios. And if we had glide path enabled, we would see that transition slowly over time from here as well. If we go back to gear icon and settings, there is another option when it comes to allocation methodology. So if we scroll a little bit further down and use this drop down, we also have the option for no blending across account types. Now, this is a very different approach when it comes to allocation methodology. A very important assumption to note for the other planning or allocation methodologies is that it's going to be assuming that we're blending the portfolio together and having that designated split. Now, the no blending across account types in particular is going to be assuming that we're not blending the portfolio and that each of the different types of asset buckets are going to be following their own allocation indication, their own asset allocation. And a very important thing to note is if we select this option, this would disable our ability to propose allocation methodologies. So if we wanted to indicate in the proposed plan that they switch over to a more aggressive model portfolio or a more conservative one, we would no longer be able to do so because we would require the assumption there that we are blending the accounts into that model portfolio. So this is going to be following their own separate rates of return. Versus if we select any of the other ones, it's going to be assuming that the portfolio, the investment portfolio, is following the same asset allocation. Now, there are, of course, unique products that I just want to note. So things like 529s, annuities, those are unique products that are following their own rate of return. It's going to be for those other types of investments. So in this case, we'll keep same allocation for all years selected. Another very important assumption that we're going to see here from the drop down, so if we switch over to the right-hand side of the screen, is the cash flow and simulation starts. So this one's a little bit more straightforward. This is just indicating when do we want our cash flows to be starting. So right now, what we have selected is January 1st of this year for the start. So when we look at the cash flows, we're looking at January 1st, 2025, ending December 31st, 2025. Then 2026 is starting January 1st of 2026. You do have a different option, a couple different options here though, which is starting with January 1st of next year. If I selected this and hit save, that would just be shifting the cash flows to start January 1st of 2026, still ending December 31st, 2026. So it's still gonna be looking at the full 12 months. It's just a different time frame. So this is typically one of those ones that maybe towards the end of the year, when we're already starting to plan for the future years, we've already accounted for what happened in 2025. All the cash flows are accurate. The balance sheet's already aligned. We might be switching to January 1st of next year. Just want to make sure that if we do that and we want to switch back to January 1st of this year, when next year hits, that you do so in the client plan. The third and final option is a little bit of a different approach. All three of these are still looking at a full 12 months, but the current month projection or the rolling 12 months, we just hit save. What that means is that it's going to be starting the cash flows as of June 2025, ending June 2026. And it's a very important thing to note when we have this selected is that if we're starting in June 2025, we just want to make sure we're keeping in the back of our minds that if we have any sort of goals, income, or kind of expense that's indicated to start at the beginning of the year, we're not going to be capturing that because we're assuming that the cash flows are starting June 2025. So if we go to retirement cash flows, we're going to see this a little bit better illustrated out. If we go to cash flow summary, we're going to see here that we're going to see the ending year indicated here, so 2026, but it is assuming June 2025, ending June 2026. We will also see here the ending age that the client is by the time this year passes. So we'll see that they're 60 by the end of 2026, June 2026, then 61 the following year. But like I said, this is going to be something really important to note with this particular cash flow projection start date is that anything that we have indicated that's starting 2025, most times it's probably going to be something we're indicating that's starting at January 1st of 2025. So it's important to note that those things are not going to be captured here if we have this selected, because we're indicating here we want the cash flows to start in the middle of the year, essentially. But this might be what we're selecting in the instance where we have the balance sheet and we're trying to align it with a future date in the year. That might be when we're selecting this option. But for most cases, we probably would be sticking to January 1st of this year or next year, especially if we're looking at more precise calculations, such as prorating retirement dates to specific months or Social Security filing, just because if we're looking here, we have to keep in mind that it's a rolling projection. So every time or every day we come back into this space, it's updating to consider that we're starting June 2025. If we come back in July, it's rolling month projection. So then it's going to be looking at July 2025 to July 2026. So just to keep in mind there, if we have current month projections selected, that anything that we might be prorating or might be month specific, we have to just keep that in mind of where we are in the months. But if we go back to gear icon settings under methodology, I'm going to switch back to January 1st of this year for my plan and hit save. Now, another assumption that's going to be important to note, this is going to be really relevant when we are looking at making distributions from accounts, specifically when it comes to RMD age. So the plan distribution method, this is where we indicate how do we want to approach and treat us indicating manual distributions from their assets when we also are considering RMDs. So this is going to be relevant for once the client hits RMD age, required minimum distributions from those tax deferred accounts, and if we are indicating a manual distribution. So for example, if we are noting that we know that this client in RMD age, once they hit 75, we are going to be sending them $15,000 from the 401k, irregardless of any sort of RMDs. We just want that to be something that is going to be indicated because we know that's what we're going to be doing irrespective of any sort of RMDs. That might be when we're selecting RMD added to manual distribution. So this particular assumption means that we are going to be separating RMDs from those distributions. So it means that we're going to be indicating, if we indicate that manual distribution from the tax deferred asset, that would be on top of any RMDs we indicate. The second option here is going to be a little bit of a different approach. It's going to be assuming it's the greater of RMDs or manual distribution. So if I indicated that I want to distribute that $15,000 from the 401k post-retirement minimum distribution age for this client, we would be then looking at, does that distribution satisfy RMDs? If it doesn't, we would then see an additional distribution from the account to satisfy the RMD. But if it does satisfy that, we would then just see our distribution. The final option here is to indicate no RMD. So this is essentially turning off the calculations for RMDs. So if we don't want to have that calculation occur, we simply want to enter manual distributions, we can select that option as well. But if we select RMD added to manual distribution, just to show what it would look like, if we go to profile, income, and if we click on add income, we can add a distribution from their account. So go to add income distribution. And then let's say we're going to be pulling from the 401ks that they have. So let's say this is going to be $75,000. It's a fixed dollar amount, so we'll leave that selected from Tyrion's 401k. We can have this start at Tyrion's age, 75, and end at the end of his plan. And let's say we want this to increase by 5% per year. This is a normal distribution, and we'll keep it to standard rule for taxation. So now that's how we model what's considered the manual distribution. So we just manually indicated that we want to have distribution from the 401k, from Tyrion's 401k. If we go back to the cash flows, where we can see a lot of those great insights for the client's plan, go back to retirement cash flows. Under summary. So this is where the plan distribution column here comes into play. So if we click into the plan distribution column, here we can see, and we can click into the 401k. We can see here that distribution and then the RMD as well. So we'll see the separated line item here, and what we indicate for that methodology when it comes to how we treat that plan distribution is going to determine the figures that we see here, or at least the approach that we're taking when we take that manual distribution. Do we also want to have RMDs added to that, or do we want to take the greater of this RMD or distribution? So we can see here, for example, let's say this was the RMD, it would be satisfied by this distribution. So if I switch my methodology there, going back to gear icon settings under methodology, if I switch over to greater of RMD and manual distribution here and hit save. When we go back to retirement cash flows, we're going to see that it's a little bit of a different approach there. Once again, going to retirement cash flows under summary, and then clicking into the plan distribution column to see more insights under the 401k for Tyrion specifically, we're now seeing we're taking that greater of. So what we saw before was the RMD was $61,000 roughly, but because we've indicated we're having a manual distribution, we know we're sending the client $75,000 post RMD age. We're now taking that and satisfying the RMD. But if that's not the approach we're taking, we can switch that assumption as needed. So that's just going to illustrate what that looks like in terms of the impacts of those projections. But if you go back to gear icon settings under methodology, we have another very important assumption to cover. And this is specifically when it comes to cash management. So another thing to note when it comes to allocation method, that was referring to the investment portfolio. But we have a very important assumption we want to take here or indicate for this client plan, which is how are we treating the money that we're indicating that are in the bank accounts? Do we want to treat the bank accounts as cash, or do we want to take a little bit of a different approach? And that's where the cash management method comes into play. So the first option that we have selected is treat bank account as cash and then spend cash before taxable, or we have the option to spend cash after taxable. This particular option is indicating that we want to treat whatever we're putting in the bank accounts as cash. It will be earning the rate of return as cash. It'll be a separate line item, and it'll be indicated as part of that essentially cash bucket. The second kind of piece here is, do we want to spend that cash before the taxable bucket or the brokerage account, or after the brokerage account in the event of us needing to pull from the taxable bucket to fund those outflows? So in the event of that negative net flow, do we want to first tap into the cash that we have on hand, or do we want to pull from the brokerage account? The other option that we have here is that slightly different approach. It's what's referred to as using the cash reserve goal to manage cash levels. If we select this, this is indicating that we want to manually control how much we have invested in cash and earning cash rates of returns. If we have this selected, it's really important to note that anything that we have in the bank accounts that is not captured with that indicated cash reserve goal is assumed to be invested into the brokerage account and earning the rate of return of the portfolio. So if I select that and hit save, we go to the profile section. We can see here in the bank account, we've got $140,000. Just to note there, that's going to come into play when we go to the goals section, because now we're going to see the option to indicate a cash reserve. This card allows for us to indicate how much we want to be earning that cash rate of return and essentially being treated as a bank account. So we can indicate here, maybe we just want to assume that that $100,000, we want to assume it's reinvested. That's earning the rate of return of the portfolio, of the investment portfolio. So we'd be indicating here 40,000. That's what we want to have set in the bank, earning cash rates of return. Can indicate that owner, it's jointly owned. And then we can control the time frame. So if you're looking to fluctuate here, like pretty drastically, the amount that we're having maintained at cash rates of returns, we can model and layer the cash reserve goal cards. So if for right now, when they're still working, we're comfortable with that $100,000 being, reinvested. We want to just stick with the $40,000 earning cash rates of return. But maybe once they retire, we're upping this goal significantly. Maybe we're putting it to that $100,000. We can indicate that and layer the cards if needed. So we can control the start and stop time. If we wanted this to be assumed, it's happening towards the end of plan, we can select that. And then another thing that we can specify here is, do we want this to be an increasing cash reserve goal? If we select no inflation, that means that any growth, whatever we have for cash rate of return, let's say it's 1.2%, any of that growth would be reinvested into the investment portfolio, earning the rate of return of our investment portfolio. So if our investment portfolio is earning 7%, that's earnings of that's cash would be invested into the investment portfolio at 7%. If we indicate that we want it to be tied to either general inflation, health inflation, education inflation, it's going to be increasing per year with that goal. Or we can indicate a customized inflation rate. So especially if we were wanting to account for the idea that this would be earning cash rates of return, we can use customized inflation to specify it's that 1.2%. That way we're considering the idea that this would be earning cash rates of return, and it's going to be slightly growing with that growth per year. So this is going to be that other kind of specification we can make when it comes to cash reserve goal. That's how we can manually control it, what we want to be invested at cash rates of return. Another important thing to note there is that it's not assuming that that's going to be something that's not tappable. That cash rate of return, what we have in that bucket, is still going to be something that's available in the cash flows to be tapped into. That's just us controlling and being a little bit more pinpointed when it comes to what we want to have essentially in the bank accounts over time. But if you go back to gear icon settings, I'm going to switch back to treat bank account as cash, spend cash before taxable, because that's going to be the assumption that I want to have for this particular client. Another line item that we can control here is health saving account distributions or HSA distributions. So especially if we have the situation where we don't want to have that be something we're tapping into for any medical expenses we're indicating in the plan, we can control when we want that to become available for us to start funding medical expenses in the plan, whether we want that to be considered available immediately at first retirement, second retirement, or at an age or calendar year. Another line item that we can control here is whether or not we want to show distributions from the investment income from taxable accounts. So do we want to show the distribution from essentially that investment income? And is that going to happen every year, or is that going to happen post-retirement? In this case, it's going to be never for this client. So we're going to keep that selected. And then another thing, especially if we have the situation where we have an age gap or a gap in between when the client and co-client are retiring, that's pretty significant, is when do we want retirement monthly living expenses to start? So right now I have selected that I want the retirement living expense goal to start at first retirement, but especially if maybe we do have that huge gap, maybe the client and co-client are going to be retiring with a gap of 5 years in between, and I want the retirement monthly living expenses that I have indicated to start at that second retirement, I can select that from here, and the goal would start at that second retirement. Further down is a couple miscellaneous setting assumptions that we can also control, such as do we want to include the bank accounts in the asset allocation chart? If we select this and we choose to include bank accounts in the asset allocation chart, that's just going to be for the visual representation of the asset allocation. It's not going to have an impact when it comes to projections. Just for an example, if I select that and hit save, what that's referencing is under investment, asset allocation, we can see a visualization of the client's current allocation. We can see what the split is for their portfolio. So right now, especially because I indicated I wanted to include bank accounts in the asset allocation, this split is indicating and including those two bank accounts. So we can see the annual return, 8.1%, and that 64-36 split. If I deselected that option, it would just remove them from the visual representation. And the actual rate of return would be based off of whatever that split is without the bank accounts involved. So going back to gear icon settings, I deselect that option and hit save. Going back into investment asset allocation. So it's just a little bit of a slighter impact because we don't have much in the bank accounts in juxtaposition of their other assets. We can see what the split looks like now and that annual rate of return. If we go back to gear icon settings, we also have a couple other pieces that we can specify here, such as the idea of taking annuity required minimum distributions or RMDs from the IRA account first. So if we've got a situation where we are going to be owing or needing to take distributions from an annuity, and we want to have it be pulled from the IRA account first, we can specify that from here. Otherwise, we can leave that deselected. Another thing, and this is specific to modified cash flow based planning methodology, is if we want to change kind of the visual representation of where taxable savings are in the cash flows. So as we kind of noted before with cash flow based planning methodology, any positive net flow is going to be indicating that we're saving into the taxable bucket. When we select modified cash flow based planning methodology, and especially because now we have that control to be able to specify savings to the taxable bucket, if we wanted to move that from being a positive net flow to now under the planned savings column, we can do that from here. Now the figures are going to be remaining the same. This is just going to be an aesthetic change or just a visual change in terms of where we want that to fall under the line items, but the number at the end of the year would still remain the same. The next option that we have here, and this is going to be one that can be pretty beneficial if you're looking to look at different kinds of sequences of returns in the cash flows, is allowing the display of scenario specific cash flows. So with this selected, if I go to retirement cash flows, this is going to be that secondary gauge of financial well-being. So the cash flow and the baseline projection is going to be considering a straight line projection. So it's not going to be considering volatility in the baseline projection. But what the allowing of display of scenario specific cash flows does is it allows for us to indicate and see what does it look like if we do apply different sequences of return to the cash flows. A very popular choice there might be seeing how do our assets fare? What does it look like in the summary if we do have a really poor, performing decade? So if we go to summary, for example, we'll see now the ability for us to use this drop down from baseline to different sequences of return. There's a couple defaults here, but especially if you start to create your own options back under the advisor portal under models, you would see those populate here as well. So for example, if we toggle to Fed adverse scenario followed by modest growth, once we select that, we'll see how that's going to impact the cash flows. So it's going to impact a couple of pretty important things when it comes to returns. So we'll see how that'll impact the cash flows here. We can also see how it'll impact the accounts. So especially if maybe we selected the flat 0% return, if you wanted to evaluate what is the worst case scenario, there's no returns, nothing's guaranteed. We can see what that looks like. It's pretty flat here. And we can see the same thing for summary, where we can see the cash inflows and cash outflows. And we can kind of toggle between each of those options to see how those different sequences of returns impact the cash flow implications. So that's just another option when it comes to the conversation of cash flows, especially because the baseline is a straight line projection. It's not factoring in that different sequence of return. It's guaranteed return. If you want to see what it looks like if different non-guaranteed situations happen in terms of return, that is also an option if we toggle that back under gear icon and under settings. Another setting that we can toggle here is the ability for us to use the taxable account to fund IRA or 529 savings when the current year cash flow is inadequate. So especially for these elective contributions, when it comes to 529 savings or just that, especially for self-directed IRAs or just IRAs in general, we can indicate here if we are comfortable, if the client is comfortable pulling from the taxable bucket to fund those savings. If that's not something they're looking to do, we can disable the setting, we can deselect it and hit save. And what that means is that if I had indicated that the client is, maybe maxing out their IRA savings, contributing that $6,000, but they don't have enough cash flow inflows to cover that outflow, we would just show whatever is available in the cash flows to fund that kind of savings. If we're comfortable pulling from the taxable account, we can select that though. And then further down is where we can indicate if we are comfortable with the 529 savings that we have established or have built out or are building out, if we're comfortable with that funding pre-college education goals. So if we are, we can leave that selected, but if we're not comfortable with that, we can deselect that option. And that means that any 529s that we have indicated would only be tapping into when it comes to funding college goals. But if we're comfortable with it being funding that pre-college goal, we can select that option and hit save. So this is going to be that kind of in-depth overview of those planning methodologies, the different options that we have in terms of these setting methodologies that we can select from here, especially if we're noting that we want to run with the assumption of one planning methodology over a different one that maybe you have currently selected. It's really important that you also have the ability to set presets or defaults for any new clients you create going forward. So we're going to be pivoting back to our advisor portal to show how you can set defaults for new clients created going forward in terms of those different setting selections. So going back to the advisor portal, we go to 3 dots in the upper right-hand corner. Under client settings, we're going to be greeted with client presets. So once again, advisor portal, 3 dots, client settings, and under client presets, this is where you can go to indicate what you want to have for the default methodology pieces here for any client that you create going forward. Now, that doesn't mean that you can't change any of these assumptions once you create the client. This is just going to make it so that way you can have a kind of an alignment here of what you want to have as the assumptions and the foundations of each client plan that you make going forward. But if we have a client that maybe in my defaults, I have modified cash flow base selected here, but I know that my next client that I create, they're not going to be suited for that option. Maybe cash flow based is better for them. We can make that adjustment in the actual client plan once they're created, because every single client plan has their own unique settings that you can indicate by going into that gear icon settings methodology page. But this is where we go to establish the defaults. A lot of those we'll see here. There are a couple other important pieces if you haven't already done so, and especially if you're not serving clients in the residency state that is the default, which is typically New York. It's very important that you can specify that from here so that we don't have to continuously change that per client. So maybe if we are often maybe no longer serving in Wyoming, maybe we're actually looking at mostly Massachusetts, we can select that from here. Same thing for retirement age. If you want to set the default, long-term care cost estimate, a couple other pieces here that are also pretty beneficial. National averages for healthcare costs, or if you prefer Medicare premium calculations to be the default, you can select detailed estimate. So a lot of beneficial things here that you can specify to make your job just a little bit easier in terms of indicating or making these adjustments per each client you create going forward. So once you make any adjustments to those defaults, we can hit the save button, and any client that I create going forward will be leveraging those specific assumptions. But like I said, really important that you have that flexibility to customize the plan per client. So you also can always make that adjustment once you create the client in their own unique gear icon setting section.